Well, my current take is that if anybody says they have a high level of conviction as to what's going to happen in the next several months, that you should probably not listen to them. But the way he explains it is you could have a 1929 magnitude crash at 2020 velocity. That's the world we live in today. There's just a ton of this gray zone manipulation. An incredibly difficult environment, and businesses don't want to play poker with the United States government.
Welcome to Discourse with Christian. I'm your host, Christian White, and today's guest is Carson Block. Carson is the founder of Muddy Waters Capital and a leading activist short seller known for using independent due diligence to expose corporate fraud and challenge market pricing. Carson, thanks so much for being on the show today.
Yeah, thanks for having me, Christian.
Would love to start off asking you what's your current take on the global economy and financial markets?
Well, my current take is that if anybody says they have a high level of conviction as to what's going to happen in the next several months, that you should probably not listen to them. But yeah, look, I think that what the president has just done with tariffs, I suspect that things in the real economy have been broken that will take a long time to fix. And we don't know yet what they are, but I'll start with the games that he was playing starting in February regarding the USMCA. And, one day it's increased tariffs on imports from Mexico and Canada. The next day it's just kidding. No, actually, I was serious. No, I'm kidding. The problem that creates when you're now trying to go and negotiate all these bilateral trade deals with pretty much everybody in the world is that the USMCA was renegotiation of NAFTA by the first Trump administration. So now if I'm CEO of a company that manufactures things and when we build a plant, it requires a lot of capital spending. Well, I'm looking at what he's done with the USMCA, which again was his baby. And by constantly threatening to abrogate it, I don't think that any sort of trade deal executed by the Trump administration is worth the paper on which it's printed. So how do I make long-term investments against that backdrop? And so I think what's ultimately going to happen, regardless of bilateral trade deals being executed, is that I think this is going to paralyze a lot of capital-intensive business spending. And that will show up in ultimately, not only bringing in reducing supply, but that'll also start to show up in aggregate demand by, having increases in unemployment. So, yeah, credibility for the U.S., not only internationally with trading partners on a government-to-government level, but I think between the U.S. and the private sector is damaged severely. And one of the analogies that I hear people who are defending the administration is the analogy to a poker game, and like, oh well, Donald Trump likes to keep the cards close to the vest and playing poker. Yeah, great. Okay, when you're negotiating with government to government, maybe there's an element of playing poker that you need to use, or at least incorporate that mindset. However, private businesses do not want to play poker with a host government or the home government. What they want is a clear set of rules, and then they will conform their behavior to the rules. But when the goalposts can shift constantly, radically, daily, that is just an incredibly difficult environment, and businesses don't want to play poker with the United States government. So I'm not going to tell you, how many percentage points of GDP growth this is going to cost, because that would be arbitrary and that's above my pay grade. But I do think that this highly capricious behavior has broken things in the real economy, and that which, what they are and for how long they'll stay broken, we'll have to see.
And I know you've mentioned on previous episodes and such about the brokenness of things, and which segues to my next question: what makes you believe the U.S. markets are fundamentally broken?
Well, okay. I grew up in the markets and I came up on the long side. And funny enough, my father was a sell side investor and he was known, I think, to a reasonable number of people on Wall Street as the most bullish or credulous of management sell side analyst there was, which, that's a pretty high bar to clear to be the most credulous sell side analyst. So I ultimately came out the opposite, I guess, in terms of being pretty skeptical. But a lot of that was born of watching my father get snowed by various managements over the years. So my long orientation was partly as a value investor, growth and value, and I'd say starting in 2013, I felt, and by then I was a short activist. I started that by accident, really in 2010, after I'd been out of the markets for most part 8 or 9 years. Um, I felt that 2013 was really this tipping point where, on the long side, investors stopped being remunerated for caring about risk and that it was increasingly driven by narratives. Then you had the share of passive investing as percentage of overall investing growing. And passive is now the market in many respects. So when you look at the concentration, especially they're off their peaks, but that's also explained by the phenomenon of passive eating the lunch of active. When you look at the concentration of the S&P 500 and what in the Mag 7, that is a function of passive because the S&P 500 now has effectively turned into a momentum index, right? So it buys, moves the price of something up. Well, it's got to buy even more of that tomorrow because it's now a larger share of the S&P index. And so more of the next dollar that passive investment firm invests goes to that thing that it already just pushed the price up, of which it just pushed the price up. And what's happening is when passive buys, it's taking active out of the float. So nominally, the floats of these companies are X, but in practice, they're constantly shrinking because passive will not sell at any price until passive gets outflows. And then it will sell at any price, right? But when passive gets inflows, it will buy at any price. So this is having a convex impact on the prices of the stocks that are the most heavily weighted in the index, or at least convex on the way up. And also, when you're getting outflows and risk off, then it's going to be heavily weighted toward those names in terms of the selling. And the problem is when we have a real market dislocation, there's so little active left now relative to passive and passive selling that will need to occur as passive gets outflows that there's no one there really to catch the falling knife, aside from a few short sellers that are still left in the market. So to me, those are the things that, that's why the US markets have been broken. It's passive. It's also just the anesthetization to risk that's caused by all this emergency monetary policy that really, long outlasted the emergency. So yeah, and I think that's an important point too, because since the GFC, I would say we've had two generations of investors come into the market since the GFC. And I think to them, risk is just an opportunity, right? The only real risk they've seen since the GFC effectively was COVID. And COVID was like the best thing that ever happened for financial assets. And that probably cannot continue to be the pattern indefinitely. So those are the reasons why I think main reasons why I think the markets are broken. Algos also add to it, add to the inefficiency by disintermediating fundamental analysis or analysts from the markets. But I'd say that's a second level issue versus the two former issues.
And then for my third question, as it relates to the macro kind of big picture, how has passive investing reshaped price discovery and market dynamics? If you can kind of unpack that.
Well, yeah. So if you think about, and this is the person to follow if you're interested in this, is a guy named Mike Green, and he's presently, I think, CIO or of Simplify Asset Management. His Twitter handle is at ProfPlum99. So Mike, for years, has been down this rabbit hole of how passive distorts the market for equities. And the analogy that he uses is if you have a bag of marbles, so assume it's 100 marbles, they're all black. That represents the float of a given company's stock. And the black marbles represent active investors. So passive comes along, passive is going to buy. Passive will represent with white marbles. So you remove one black marble from the bag and replace it with one white marble. Now, after a while, because passive keeps showing up to buy, you have not that many black marbles and you have a lot of white marbles. So again, until there are outflows from passive, those white marbles do not sell. I mean, they are, they are basically hodling, until the end of time, or at least until they get outflows. So with supply constantly getting squeezed, and more money coming into passive and it buying and paying whatever price it needs to pay, that's what creates this. It's not a linear impact on stock prices. It's a convex exponential impact on stock prices. So when you're looking at the companies or the stocks that are the primary beneficiary of flows, so the largest weightings in the S&P 500 index, or if you go back a few years when ESG was hot, like the big names in, the big weightings in the ESG indices, or, the green tech indices, whatever's hot, that's where you get the real warping of the prices, because nobody is sitting there just trying to decide, hey, is this stock worth it? And that's where you get these equity values that become totally divorced from the economic values of the companies that they supposedly represent.
I see. And do you see similar, as it relates to passive, the passiveness that you've mentioned, as opposed to more active? Do you see similar passive-driven risks emerging in markets outside the U.S., like Europe? For those in the audience who are not aware.
Yeah, I mean, passive, from what I understand, and I haven't really gone into the numbers, but I understand that passive is growing to be a larger share of overall investment flows there. Now, Europe is much less of an equity has much less of an equity investment culture than the United States does. So in Europe, there's a lot more focus on corporate debt than there is in the US in terms of what ends up in investor portfolios. But yeah, I mean, there's the whole idea behind passive, and I respect this, is that so many active managers are overcompensated and they're basically just hugging indices, right? Maybe trying to outperform them by a small margin by, underweighting the obviously, poorly performing names and overweighting the ones that seem like they're performing well. So why would you pay a premium for that? That's very fair. But the problem is when passive becomes too large a share of a given market, then and it effectively then starts dictating the prices and distorting them. So I don't know what the proper percentage of flows really is, and that's probably a Mike Green question. But I don't think in Europe we're at that point yet where we see the types of distortions that we've seen in the U.S. But could it get there? In theory, yes, it could.
Gotcha. And would a recession be the most likely trigger to break this passive-driven cycle?
Sure, if you have unemployment rising enough, then you get net outflows. I mean, the primary drivers of passive buying in the U.S. are the target date funds or 401k funds. So if you have people drawing them down and the outflows exceed the inflows, then yes. And then you can get a cascading effect where people who have more discretion over their investments, and have allocated to, SPY or whatever, if they're losing money, then they can go risk off. And again, you get the situation where there's a lot of fragility built into the market as a result of all this passive, because you just don't have that much dry powder among active managers who could step in and say, this is a tremendous bargain, I'm buying it here. So that knife can fall very far, very fast. And again, so Mike Green, the way he puts it, maybe this comes across as a bit too pithy, but I don't think it's probable. I don't think it would end up being that far off the mark. But the way he explains it is you could have a 1929 magnitude crash at 2020 velocity as a result of the fragility that has been created by the massive share of the market and the flows that are attributable to passive.
I see. And as it relates to the Federal Reserve, how do you see the Federal Reserve responding if passive flows reverse due to rising unemployment?
Well, everybody likes to think there's a Fed put, right? I mean, they will keep trying. So looking at the response to COVID, and then, going back to my history in the markets, and I got my Series 7 in 95. So, I was involved in markets before then, but so call it 30-ish years. What I've termed this the powder keg economy, right? Because we build this powder keg and fill it with powder, which is leverage. And then eventually it blows up because there's too much leverage. And the response has always been, well, let's just build a bigger powder keg and stuff it with more powder, leverage. And then that blows up and you build a bigger one. Look, I studied, undergrad finance degree, read a lot of economics over the years. Everything I've learned leads me to believe that this cycle cannot continue forever. Now, could this cycle continue for the duration of my lifetime, assuming I live, at least the average life expectancy in the U.S.? Yeah, maybe. I don't know when things break. Or when you no longer can put the powder back in the keg. But the Fed maybe is more constrained now than it was previously. Going back to though this, we kicked it off the discussion about tariffs, et cetera. My concern there also is that over the long term, over the medium to long term, that this could be deflationary. So to the extent that that ends up being somewhat correct, then yes, that would in theory provide the Fed with lots of room to basically, pump money into the markets and, buy securities and, and push down and push down yields. Now, I don't think that's a healthy response overall, but, it's how they always treat the symptoms. And I don't know. I'm not sure that we really have the appetite to actually treat the cause, the underlying sickness in our society.
And as it relates to that and systemic risk and fragility, I'd love to ask you, do you think we're headed toward an inevitable financial explosion? Obviously, nobody knows. No one has a crystal ball, or just more cycles of crisis and rescue?
Look, I feel like almost everybody who's a short seller has probably predicted 10 of the last one, financial crises. So I don't really want to answer that. The world is such an unpredictable place. And I remember, so I think it was 2004, 2005, I was speaking with somebody who'd been a professional investor for, at that time, I think about 40 years, more than 40 years. And I was talking about like, hey, I think we're headed toward a Great Depression. What's going on in real estate makes no sense. And I at that time I'd been in law school, so I didn't have access to information on a lot of information on credit. So I saw this more as an asset issue, and I wasn't really understanding the credit side as much. But I was saying like, shouldn't we all be in gold and farmland and buying cans of tuna. And what he said to me is, he's like, look, I get what you're saying, Carson, and I've been feeling the same way about financial markets ever since I entered them in the 1960s. But it's like they've always found a way to keep it going. And that's just what you have to realize, is that the vested interests in preserving the system are so strong that they'll figure it out. And like, he was right. I mean, I was right in the sense that we had this huge we had this financial crisis in 2008. So I was correct about that, but he was correct that, notwithstanding some real dislocations, things got back on their feet reasonably quickly. And then, boy, did asset prices ever take off after that. So because of the policy responses. So yeah, I mean, does it all blow up? And theoretically, yes. But again, I'm not going to place a bet on timing.
And as it relates to a dislocation, what signs would indicate we are nearing a major market dislocation?
Well, I was pretty sanguine until a few weeks ago, to be honest. So I think, like a lot of people, I'd expected Trump 2 to be similar to Trump 1 in many respects, sort of when it came to economic policy, fairly similar to the Republican conservative policies, since the Reagan years, in terms of lowering taxes, deregulating. Yeah, maybe, we all expected a little bit of protectionism in the form of, I think, maybe 10% tariffs, which is not nothing, but compared to what was announced on Liberation Day, they are nothing. So I had been pretty sanguine, and I answered that very question by saying, well, I would watch unemployment rates, and again, thinking about, are the target date funds going to start getting net redemptions versus contributions? But now things are quite different, and the Empire Manufacturing Survey has just come out. It's interesting, but I mean, April is just a month of significant reversals in that. So I don't know what to watch exactly at this moment in time, but going back to my concern that capital investment could really dry up in a lot of industries. Yeah, I mean, that's, I just, like, I think you now have to look at a wide range of data points. I mean, at least right now, and this is not a good thing in terms of the direction which they're pointing, but it's a good thing in terms of simplicity. You're starting to see these data points line up. I mean, what's always hard is when you see, some data points going one direction, other data points going the other. What does this mean? I mean, things are potentially starting to look pretty rough for businesses, especially manufacturers. So yeah, I would say keep watching that in unemployment. But I'm not a macro guy, so do it anyway, but take everything I'm saying here in particular with a grain of salt.
Gotcha. And now segueing over to short selling and market role, what role do you see short sellers playing in today's market ecosystem?
A very small one. I mean, like, short selling as a business has been obliterated since the financial crisis. So, that's why it's funny when you get to some corners of FinTwit, and you see people like these real tinfoil hat conspiracy theories about, oh, the big boys didn't want to see the stock go up, so they made it go down. It's like, come on, if you had any idea how things really work, I mean, the amount of assets that are focused on short side versus long side, I mean, it's like a grain of sand on the beach, basically. Nobody really makes money off the short side by and large, especially the quote big boys. They're all net long, like your Tiger Cubs, and they're generally very net long. Um, what gets a lot of attention is the type of business I'm in, which is activist short selling, which is so short selling is a niche and activist short selling is a niche of a niche. And what rather than focusing on looking for melting ice cubes where we think that the business and is deteriorating faster than the longs think and they're going to start missing earnings sooner, like that's traditional short selling. As activist short sellers, we're looking for businesses where there's a problem with what the company has disclosed about the past, right? So usually there's some element of, if not outright impropriety, if not illegality, let's call it impropriety by management. So the company said that, X happened. Well, X didn't really happen. Or, yeah, but they left out Y. And Y is very important to understanding X. And if you understood or knew about Y, then you would see that X was kind of illusory. So, bread and butter, or an example of bread and butter type of thesis that we do is company A reported $1 share in earnings last year. Well, turns out that 40 cents of that dollar came from sales to an affiliated company that's not consolidated, that were funded largely by debt, and that debt was issued effectively on the credit worthiness of company A. So those 40 cents are not real. Therefore, you should back them out and look at this business and think of it as having earned only 60 cents a share. So that's a core, and that's not fraud. That's financial engineering. I mean, the things that for my business, Muddy Waters, the things that we write about, I'd say that we think are actual frauds. That's maybe only 20 to 25% of the companies on which we publish. A lot of it is this gray area stuff where, okay, you could argue in some cases that they violated the law, but because you had, a few law firms agree to it, and language was negotiated between the auditor's law firm and the issuer's law firm, and everybody's okay. Yeah, there won't be a conviction, so there's never going to be a prosecution or even a civil action brought by the SEC. That's the world we live in today. There's just a ton of this gray zone manipulation. So our business generally is not saying, hey, so we think the future is going to hold, the following. It's to say, look, this is what you believe about the past because this is what you've been told about the past. That's not accurate. Here's what the past really is. Okay, now you as the long investor, you extrapolate the future. But if you accept that the past is actually much less rosy than you thought it was, you will probably extrapolate the future is not going to be as great as you thought it was before you understood what really happened.
Gotcha. And as it relates to obviously your firm and the due diligence that it conducts, and as it relates to fraud ethics and market behavior, do you think corporate bad behavior today is less illegal and more just normalized?
Well, I mean, the gray zone stuff I think is much more widespread than it previously had been, and I think that this is actually, I think it's a microcosm of really what has impacted trust in institutions across the West over the past couple of decades. Where things that are not outright illegal, like people who have people who are in power or have the ability to do so kind of turn the dials to favor them or favor their friends. And, like after a couple of decades of this happening, I think we have really hollowed out institutions in many respects. And, I think that this is also, that you see this, maybe you see this, it's most evident in the capital markets. I think it's also deleterious when you see for investors to see people get away with this type of behavior, right? So I think Elon Musk is a great example. Now, whenever I discuss or write about Elon Musk, I manage to make everybody mad because the short sellers, who hate him, like I will recognize the greatness and the great things. incredible things he's done. Okay, so they're never happy with me on that. But then the people who are the worshipers and the fanboys, they don't like when I point out how much he lies. I mean, at times it's been almost pathological, and that I think he's actually, in many respects, a very low quality human being. So when you look at him and the pay packages, the incessant lying, and he has only been rewarded for that, and he is so high profile, like that. This is what I used to say about China. I lived in China for a number of years. I was a lawyer there. I had a real world business there, and I used to say that the problem with China, why everything there, every business, every transaction is so subject to corruption, is because it starts at the top and cascades down. And that if you have corruption at the top, whether it's an organization or a society, it will cascade down. So you look at a guy like Elon Musk. You look at some of these other people who've become billionaires. Guys like, I don't know, like Chamath likes people think he's a billionaire. I mean, he's obviously very wealthy, but he made a lot of that money the wrong way. On like ripping people off on SPACs. So when market participants see that that such a large portion of the wealth in this country is controlled by people who are playing fast and loose at times, well, what does that say to you? Do you want to be the sucker who follows the rules? And then, look, without getting too political, and I will not ever pound the table in favor of Kamala Harris or Joe Biden or the Democratic Party. Like, I loathe pretty much everything about that party by now. But Donald Trump is a guy who has, in broad daylight, broken numerous laws. And okay, like the whole New York, prosecution, that was total BS, right? Like that was so stupid, and that was just ridiculous. But it's not a secret that, the guy has, like evaded taxes he did for a number of years. And again, when you see that as an ordinary person, and I've seen, like, I'm involved in a lot of litigations, and I've seen this in affecting me as well, because like I'm involved in a lot of litigations because it's a litigious business. We get sued a lot by companies that are upset. And yeah, like I used to be a lawyer, but watching Trump during the first, his first administration and then afterward, basically say, like, every time there was a subpoena, like, F you. I started asking my lawyers, like, well, what if we just said the same thing? Like, like why are we the schmucks who, like we're getting slammed with lawfare constantly? Like, why do we really have to, like, what makes this judge, what puts this judge in a position of moral authority anyway? And it's really led me to ask these questions. And then I'd take a step back and say, that's kind of dangerous, but that's really a symbol of, I think, I think a cultural change that has been occurring in our society, and probably a number of Western societies, because we just see it at the top. We see our Congress people, both sides, obviously trading, on what we would deem to be insider information, and they refuse to make it illegal. Like, we've had a long running joke here that we'd love to hire Nancy Pelosi as a PM because, like, she's the best goddamn investor I've ever seen. Like, that's semi tongue in cheek, but these all have deleterious effects on our society and weaken the social fabric, weaken the bonds of trust. And that's, so that I think is, I think what we see in the market, it's both a reflection of this, and it's a furtherance or cause of this. It's a vicious cycle, basically.
And as it relates to that in some of the gray areas, my next question is, how do executives take advantage of gray areas in financial reporting and earnings guidance? So you can kind of get more or less granular on that.
So, right. So, like, you could say, if you're, people could say, well, what's so wrong about engineering your earnings and making them look better, and, booking revenue that, in the current period that, like, arguably could be booked in future periods, but, especially things like software where you have latitude. And The answer is because it's mortgaging the future of the businesses. So, in an environment where people don't care about more than a quarter out, and look, at the end of the day, I mean, whether we're talking political dysfunction or market dysfunction, at the end of the day, it really is the fault of market participants who do get fixated on this quarter, next quarter, as opposed to 5 years or what have you. But the equity compensation packages are so large for so many managers that they really only need to clock in a few good years, at least optically good years. If they can ramp that stock price, especially if they can take advantage of passive flows, that they can ride off into the sunset having made a ton of money while the companies crash and burn. And you see this example, like you can see this behavior manifest itself in numerous ways. China is a great example, right? In the sense that you had all of these advanced manufacturers setting up facilities in China, knowing that they were going to have IP leakage to the Chinese side. But the CEOs were thinking, some combination of, well, we need a China story because everybody else, has a China story, and I want to pump the stock and tell this China story. To, yeah, like we'll be able to improve margins by manufacturing here. And yeah, what are we talking about? A problem here, that's 7-8 years out, bro. I'm gone. You know how many stock options I've sold or how much stock I've sold between now and when it matters? Like tens or hundreds of millions of dollars. So that's one way in which it's manifested itself or that's one way in which you see the mortgaging of companies' futures has been, the headlong rush into China while understanding and accepting that this is weakening the company's technological edge and in leaking IP, in ways that's gonna harm the company over the long term. But in the short term, or in other examples you see are companies that take on debt on the back of these financially engineered or juiced numbers, or engage in a bunch of acquisitions. I mean, acquisitions are a great way to muddle problems in your core business because, there are always these games played. It's gray zone, right? Is this a non-recurring expense? Maybe we can call it a non-recurring expense, even though it really is, and attribute it to the acquisition strategy as opposed to weakness in the core business. And then we start, then we get Wall Street hooked on, these non-GAAP numbers. I mean, to me, that's one of the biggest farces. I was in the markets when the concept of non-GAAP came about. It was because in 2000 or 2001, FASB mandated that companies start expensing their grants of options and equity. And this was a big, this mainly was impacting tech companies. So, I mean, during the internet bubble, nobody wanted to hear the bad news, right? So we came up with this, the non-GAAP earnings, where we're just going to ignore the Black-Scholes cost of the equity and options issuances. But then, it expanded to, everything could be non-GAAP, like your EBITDA could be non-GAAP, your, like there are companies I'm sure who report like non-GAAP, like gross profits. And so it's become this lie to me culture, which this dovetails with the things that I was talking about earlier. But when, so long as you can get away with reporting numbers that sound good, I mean, that are optically good, but that are fueled by debt or in some way are compromising the foundation of your business, for the future, that is a problem. And that's just everywhere. And I guess the final point to make there is, if you take a CEO of a publicly traded company who doesn't want to do that, but he looks around and, he'll have alongside activist investors coming in and basically pressuring him, like, why aren't you levering up the balance sheet and buying back shares? Like, that's another way to kind of squeeze the stock prices higher, especially when you have passive. If you're in an index and you start augmenting the index buying by buying back shares, why aren't you doing that? Why aren't you, more aggressive about XYZ? And, after a while, if you want to keep your job, it's a race to the bottom. You do what you need to do. And so, I do think I'm not advocating for stocks to only trade, once every 6 months, but there is a cultural issue here, and I don't know how to solve it. I have no ideas as to how to solve it, but the reality is that being a publicly traded company can definitely warp decision making, and I think net often in these, in this era, often can make the business weaker over the long term as a result of the short term pressures and rewards.
And as it relates to stocks, what's your take on stock buybacks? Is it essentially legalized price manipulation?
Well, the nice thing is, there's no taxable, there's no taxable gain until you sell them. I mean, they're great for investment managers, right? I mean, because, their investment managers are the only ones who are effectively getting paid on a rising share price that when the stock has not actually been sold. But yeah, understanding these dynamics about shrinking the float and how that has this, what can become a convex or exponential impact on stock prices, it can be a good use of the company's capital from short-term perspective. Look, there's obviously an optimal level of, in theory, right, the M&M theory, there's an optimal level of debt that a company should carry because it's lower cost than equity. But the environment always changes. And so if you have a company that has strong cash flow, that has a small amount of debt, doesn't have a fragile balance sheet, and you're buying back some stock because you don't have better opportunities out there for your capital, I think that's legitimate, up to an extent, right? When you're borrowing money to finance buybacks, then I think you're way beyond the line of what makes sense, unless there was just some very short term, temporary reason why you're borrowing in a given period to finance the buyback. Like maybe you just made a major acquisition, which I would argue that a buyback coupled with a major acquisition is probably almost always a bad idea. But yeah, so I think the short answer is it depends. But in practice, we see companies that I think have no business buying back shares doing so.
I see. And regarding risk and monetary stimulus, do you think investors have become numb to risk after years of monetary stimulus?
Absolutely. And it was funny. I was saying that towards the end of 2019, we were marketing, and that was kind of my line was, because people asked, well, what about the opportunity set in short activism? And I was saying that, every year the bar for finding, stories, like I analogize, well, actually, it's not really an analogy. I consider activist short selling to be investigative financial journalism, just married to a different revenue model, one that actually works, or can work, whereas subscriptions and ad revenue don't work to support real in-depth journalism. So if we think about it as journalism, we're talking about reporting stories. So what I was saying at the end of 2019 is that the bar for finding stories that people care about each year since the GFC has gotten higher and higher, just because people are increasingly anesthetized to risk by the emergency excessive monetary stimulus. And then COVID hit. And boy, was my point ever proven, at least to in my own mind. Yeah. And so it obviously just became ridiculous. By the time we got to early 2021 and you saw this, like people deliberately buying shares of crap companies for reasons of nostalgia, AMC, to punish short sellers, GameStop, like non-economic reasons, really. Um, that tells you that, there's a real problem with markets, and that there's, an underappreciation of risk. I mean, when, at least in previous bubbles, like the internet bubble or the real estate bubble, there was an ostensible rationale. Well, real estate prices, never drop, on a nationwide basis. I'm sure it'll be okay. Or, productivity gains, this thing is the internet. It's, it'll be worth, it'll grow into the valuation eventually. At least people were able to tell themselves they were telling themselves little, like lies that had to do with the, that seemingly made the value that equated what they were paying with, economic value of the asset. But then when we got to late 20, early 21, like I said, that was all out the window. It's just like, nah, let's burn these guys, push the stock up. Like, just, all right, well, what do you say to that? When people are, willingly, immolating their money, like knowingly and willingly immolating their money in furtherance of some social goal that's like anti-economic, I don't know, man. Like, it seems to me that we have a problem.
Amen to that. Wanted to then segue to structural reforms and accountability. I know you touched a little bit on it, little bit earlier on in the episode, but what changes would you like to see that could restore integrity to financial markets, even if it means fewer opportunities for short sellers?
Well, and look, I'll say this: I still feel that I'm still a value investor at heart, and I mean that's why we have in recent years we've branched out. We've been doing long investing in Vietnam for a few years, adding India. We've been investing long oriented in metals mining, not crypto. So I'm not, like I kind of want a return to that world where I don't feel that so many things out there are shortable. But it depends. What reforms depend on what exactly we're talking about. Passive, as we've discussed, passive is a problem. I don't know exactly what you do, because if you say, well, we're going to cap the percentage of share ownership or float ownership held by passive, then you create these quota systems where you're going to have dispersions between what the underlying trades for and what what the non-passive share class trades for and the passive share class trades for, and then all of these passive funds are going to be engineered to look, technically be actively traded funds, even though they're effectively just following an index. So I don't know that there's a regulatory or legislative fix that would actually work, but the concept, conceptually, we need to dial back passive to being a less meaningful form or less meaningful portion of the equity markets. When it comes to active management, one of the other problems is that we've seen so much concentration of assets among the relatively small number of active managers that are left. And that part of that was a post 2008, post Madoff reaction where allocators, were acutely made acutely aware that you don't get fired for hiring IBM. So there's been that trend in especially the hedge fund industry. But what that takes away a lot of the innovation from from the markets. It takes away the small scrappy firms who are looking for these little pockets, where they have, they can find these ways to make money that just don't, that are too small for a large player with 30 billion in AUM as a hedge fund that's pretty large. Wouldn't make sense for them to pursue. But on the regulatory side, it's much harder to be a small manager now, and this is something I speak about a lot. We manage ish 300 million. Now, the SEC, the requirements that went into effect in 2011 through the Dodd-Frank legislation is that private fund managers, so we manage private funds, they're not open to the general public. Private fund managers were required to become fully SEC registered once they got to 150 million in assets under management. Okay, as of the beginning of this year, if you look at the rise in the S&P 500, that 150 million today, inflated by that same factor, or 150 million in 2011, would be about 700 million today. Okay, so we are well under that threshold, but we must be SEC registered, and that triggers a lot of compliance costs. And what's happened in the market for fund services, like I remember, I think it was 2012, it was the first time I paid for big firm securities counsel. I had to give an on the record testimony about some China based issuer, and That attorney was $1,200 an hour. And when I heard that, I almost fell out of my chair. And I think I quipped something like, wow, this is, I better be getting like some of the most profound wisdom I've ever received in my life if I'm paying $1,200 an hour for it. Like literally, that rate is now $2,500 an hour. So, and all of the non big firm, their securities counsels, their rates have gone up by about the same factor too. So, the 150 million threshold is far less meaningful than it was in 2011, and the cost of the service providers have gone up significantly. Another factor that's driven the increase in service provider costs is that private equity firms just keep rolling these things up. You buy these outsourced IT providers, you cut spending, you turn them into just horrible companies that who their customers hate, but we're required to deal with somebody because that's what the SEC expects if you're fully registered. And so and they jack up the prices. So that's another factor. So if we're looking at, if we want to encourage more innovation and more heterogeneity in investing, we need to dial back the regulatory burden on smaller funds and really raise that 150 million registration threshold or get rid of it altogether. I mean, it's not what caused Madoff. Okay. Madoff had a lot of AUM. I think from the perspective of integrity of financial statements, everybody misunderstands what auditors do and don't do. Auditors are not there checking to make sure there's no fraud. That's literally not their remit. They're there to ensure that the correct accounting standards are applied and that they're applied correctly. And they've become, their incentives have warped that massively over the decades as well. I mean, they're happy to let a company be as aggressive as the auditors council will allow. So usually the aggression is handled by some highly opaque disclosure that is in the back, that's in the notes of the financials. That's the product of negotiating between the issuer securities council, which wants to write a bunch of gibberish, and the auditors council, which is willing to accept some level of gibberish as long as they can point to it and say, well, there's enough that's cognizable there, like a few words of English that, you can't hold us liable. So that's where the state of auditing is. And that's encouraged by this legal fiction that auditors have been allowed to avail themselves of since Enron. And so if you remember when Enron blew up, Arthur Andersen was disbanded as a firm, and it went bankrupt and what have you. So following that, what these global audit firms have done is they basically they've changed what they claim their model to be. Now they claim to be networks of member firms. But, everybody will use the Big Four moniker, locally. This is Deloitte, Bangalore or what have you. But, and money moves freely throughout these structures. Partners in the US and Europe are making money off the expansion into these new markets. And so money's moving freely. People move freely throughout these structures. They're seconded, partners from Europe end up in Asia, so on and so forth. But the moment there's an audit failure, it's like the gates go down. It's like, oh, no. You cannot hold us and you cannot hold the U.S. partners liable for this. No, this was our network member firm in such and such. No, you got to go talk to them. So, so effectively what the structure allows is heads I win, tails I don't lose type of risk taking in the audit process. So yeah, if I had my druthers, there would be legislation or regulation that would actually hold the partners globally financially accountable for audit failures and not let them make these claims of firewalling liability through this network structure. And look, I think that could be reasonably achievable, but for the fact that these firms, especially the Big Four, are so good at lobbying against anything that would crimp their profits or make them actually, be more selective in taking on clients. But those are some of the issues. I mean, I'd probably fill up another, hour with, laying out issues, but I don't know. This is probably good for right now.
Yeah, absolutely. And Carson, I appreciate you coming on. How can people get in touch with you and learn more about you and your firm?
Sure. So you can read our activist research at muddywatersresearch.com. You can contact us at info@muddywatersresearch.com. We also have websites for our Asia product. So that's muddywatersasia.com and our metals mining product, which is muddywatersresources.com. And you can follow me on Twitter, follow us on Twitter at Muddy Waters Re, R-E.
Well, Carson, thanks so much for being on, and looking forward to having you on sometime again in the near future.